financing cash flow, number one, always comes last in your entries, and number two, it's way easier than you thought. This is another top reason why I and many others here at Business Simulation Coach constantly win Glo-Bus year after year.
In corporate finance, you have to determine whether or not you're going to finance your company with debt or you're going to finance your company with equity. There are a couple other considerations in addition to that, like stock repurchases and dividends. You also have an idea of which debts you want to take on and how much interest you want to pay for each one of those debts. And the last consideration of financing cash flow is how much working capital am I going to keep in the company? It's not useful capital in the sense that you're going to make a return on investment for that directly, but it's capital that allows you to indicate to the credit rating agencies that you have things in control. And so we're going to go over each one of these aspects. First of all, we have an earnings per share, which is a healthy earnings per share, and we have a certain investor expectation. We have a return on equity. We have to pay attention to that on this page. We also have to pay attention to the credit rating on this page. And the very most important metrics are actually found down here in the right-hand corner. This debt to equity percentage. We're talking long-term debt divided by average equity, or the equity in the company. And the interest coverage ratio, which is the operating profit divided by the interest expense, and the current ratio, which is the current assets divided by current liabilities. And we're going to be very laser focused on this in order to get the debt to equity percentage and the current ratio that will allow us to have a credit rating that is half decent and be able to continue allowing ourselves access to credit markets or access to loans. The rest of the page, it projects all of the cash that's flowing around through the company. And if you need to look at each one of these little bits, you'll see that it's just beginning cash and cash inflows, and then a cash that's available from all those sources. And then there's cash outlays. And so cash balance, beginning cash balance, plus the inflows minus the cash outlays will equal this projected cash balance at the end of the year. Now, any type of projected cash balance that's just sitting there, we put it in a bank account and it could generate a certain amount of interest income. This is not an important consideration in Glo-Bus. The interest rates that are provided are very low, and they're factored based on the interest rates that are provided for loans. So if you plan on carrying any loans, you might as well put money, that excess money, if you have it, into your payoff of your existing loans, because you're paying a greater interest rate for your loan than they're paying you to have free cash just sitting around. Now, where can you find the earnings per share shares? So you have a certain profit, that's the profit right there, net profit, and then you also divide that, or rather you divide that by the number of shares. And that gives you the earnings per share. So we can raise earnings per share by two ways. We can either reduce the number of shares that we have, or increase the profit. We can increase the earnings. So this page, you have a method of reducing the number of shares, and that's to repurchase stock. So if you repurchase stock in this box right here, then you're going to be able to buy those shares on the open market, bring them into the company, and hold them in some account that allows you to be able to take those out of circulation. And that will raise your earnings per share. And it will raise your earnings per share for every year after you do that. Now, you don't want to purchase stock at a really high price, so you want your share price to be relatively small. Now, in the first year, it's very small. And the board of directors says, well, we're just starting out. Let's only let them repurchase a certain amount of shares. So they'll let you purchase up to 200,000 shares. So let's do that. Let's purchase 200,000 shares. And we're going to watch as our earnings per share will increase. And we're going to watch as we purchase shares, the reduction in shareholders' equity, which is right here. So let's go 0, and we look at the earnings per share. We go with 200, and it makes our earnings per share increase because we purchased those shares and held them out of circulation. And it also makes our shareholders' equity decrease. Now, why would it be a good idea to decrease your shareholders' equity or not allow it to get out of hand and get too high? Well, it's because it changes your return on equity. Your return on equity is the profit, or the return, which is similar to what is said as earnings, on equity, or so return divided by equity. But it's not just the equity, it's the average equity. So it takes the last year's equity, which is found here, and this year's equity, adds them together, and divides by 2. And so you can't make huge jumps in shareholders' equity as the calculation on return on equity in a single year. You need to do that over at least 2 years. So it's a good thing to repurchase stock. Now, what happens if I issue stock? I push more stock out there into the market. Well, our number of shares will go up. Our equity will increase. And that's what you'll see down here, equity increasing. And you'll have that for every year after you do this activity. So the board allows us to issue as many as 5,000 or as 5 million shares is what this is. And so let's see what happens when we do that. Let's issue maybe 1,000 shares out into the environment. And it's at $12 a share. Well, first of all, it causes the share price to go down because it dilutes the share price. But it also causes our earnings per share to go down, and it will forever after. And it also increases the shareholders' equity, which makes the return on equity less. So we don't really like to issue shares if we can help it. And if we do issue shares, we want to do it when our share price is very high. And that might be to be able to reduce or get our debt under control in that kind of situation. There's an additional piece of this page, which we haven't talked about, and that's the early repayment of our long-term loans.
Hi, liking this video will let me know whether or not it's any good. Commenting on it will also.
All of your loans are found here in your financial statements. So for year 6, which is a projected year, I'm going to look down here and I'm going to see note 8, long-term bank loans outstanding. It's all the money that I owe and the interest rates that I owe it at. Now, you can also access some of this information, like the interest rate and the original principal, through the finance and cash flow page by just using this drop-down menu. These are all the loans that I owe right now. I owe 3 loans, and this loan here is $24,000 at 7.5%. This one's 14 at 8.5, and this one's 56 million at 8.5. And so I can pay back any 2 of these loans. Let's see, I'm going to pay back maybe this one, and I'm going to pay back maybe this one as well. 2 loans at 8.5%. So let's just look at this first loan. What happens when I pay that back? Well, the money has to come from somewhere, and it comes from whatever your cash was. So now I'm at a negative cash balance, as to before I was at a positive $33 million balance. Well, why would I want to do that? And a lot of players say, well, no, I can't do early repayment because I don't have enough cash. And that's correct. However, you also have a banker that's willing to lend you money. Now, why would I trade one loan for another? Let's take a look at this. If I pay back a $64 million loan at charging me an interest rate of 8.5%, and then I go over here and I say, well, I'm going to get another 10-year loan for the same amount, the same $64 million. And I hit enter. Now what happens is I've just traded one loan here. I've paid this off, and I've traded it to have this loan. And you'll see that my projected cash balance is exactly the same. And what does that do? Well, that changes the interest rate of the existing loan from an 8.5% loan to a maybe lower interest rate. Now I have to watch that I'm not trading it for a higher interest rate loan. This is an 8.5% loan traded for a 6.5% loan, and that's the interest rate on the loan. The principal is the 64 million, and that was a good idea to do because every year I'll pay less interest, and I like paying less. You can do that with 2 loans. Well, let's trade this loan as well. It's a $16,000 or $16 million loan at 8.5%, and I want to get another loan out at of 16 million at 6.5. Well, I simply add that to this number. So I add 16 million to the 64, that's 80 million, and I'm back to the same cash balance that I had. But I've traded these 2 loans, $80 million in loans at 8.5 for $80 million in loans at 6.5% interest. That's what's called refinancing. So let's repurchase these shares. And now I've got less cash to deal with. Well, how much cash do I actually need? And the answer is we never want to let our current ratio, which is the cash or current assets, divided by current liabilities. We never want this current ratio to be less than 2. And why? Because the Glo-Bus manual said that if you do that, your credit rating will dive. And the creditors in Glo-Bus never like to see that current ratio go less than 2. The last thing that we want to take a look at is this debt to equity percentage. Are we in the right target range for this debt to equity percentage? So we can do one thing. We can change this 10-year bank loan. And I know we have an $80 million loan and we've traded it for this, but we can change this to something that will give us a current ratio of say 2. So let's go ahead and do that. We're going to use the arrow keys and we're going to go right down to a current ratio of 2. And that gives us a 0 cash balance. And that's not a great place to be. And so instead of a current ratio of 2, I suggest that we keep a little bit of a cash balance. Well, how much? Well, if your cash is less than 5% of your net revenues, I suggest that you increase the amount of a loan that you have or decrease the amount of repayments that you're doing so that you'll be able to get roughly 5% of the revenues. So let's take a look at that. There's roughly 5%, and my current ratio is doing just fine. Now, in some cases, your debt to equity percentage will be greater than this. Your debt will be greater, and your equity will be maybe too low or lower than it's supporting for your credit rating.
See the link in the description to book a Glo-Bus coach. We made a third and best way to forecast your competitive assumptions. It's available as a free spreadsheet you can download in the description.
So what do you do then? Well, it's important for you to have a target debt to equity percentage in your company. And so you need to do things like repurchase less shares, invest less in R&D, or even try to increase your profits at a different market share point to be able to support the debt to equity percentage that you desire. The debt to equity percentage that I recommend is no more than 60-40. Now you can break that rule if you really know what you're doing, but I suggest that 60-40 be the maximum debt to equity percentage and that you keep your current ratio above 2 plus a little bit of a margin of safety. So 2, 2.1, 2.2. And that will always keep you safe as the market and the conditions of your competitors fluctuate. So let's go over it one more time. The first step, increase the stock repurchase, see if you can repurchase some shares. The next step, see if you can refinance, which is swapping long-term loans for other long-term loans. And then the final step is you want to increase your long-term bank loan until your current ratio is greater than 2 plus a margin of safety, so 2.2. Now, if all of that creates a situation where your debt to equity is too much, you go first into stock repurchase. Then next you go into trying to make more profit by reducing or changing your market share. And then you try to increase or decrease the amount of R&D. Always use the R&D as the last ditch effort.
Completing the Glo-Bus walkthrough in the order presented is best. Click on this video next and don't forget to subscribe.